Joined now by Investec's chief economist, Annabel Bishop. Thank you so much for joining us, Annabel. Annabel, what's your take? Interest rates on hold or a very slight increase?
Yes, hi. Look, I think we have probably a 50-50 chance there. I'm hoping obviously for them to remain on hold, but there's a very strong possibility they may increase by 25%. And I think we need to prepare ourselves for that eventuality.
What impact would that slight increase have on the economy?
Look, I think in a way it's to prepare people for further interest rate hikes. We need to be aware we are probably going to enter an upward interest rate hike trajectory over the next few years. In fact, the money markets, the financial markets, are factoring in up to a 3% hike in interest rates. Now, that's obviously a very large increase, and we don't think it's going to be that severe. But certainly having a look at this interest rate increase trajectory, starting off with a small 0.25% increase, a small 25 basis point hike, and then seeing further going forwards will have a suppressing effect on the economy when they're all added up together on a cumulative basis.
How will it affect those of us paying off our home loans and car debt, for instance?
I think, what's going to happen is that we are going to see these gradual small increases building over the next couple of years, as I said, and it's just going to become more difficult to make your payments every couple of months, bearing in mind that the Reserve Bank meetings do tend to happen every 2 months. So it's going to cost more. And I think consumers need to prepare themselves. They need to assess quite carefully when they plan on taking more debt, whether they can afford it, given that we may even have an up to 3% hike in interest rates in 2 years' time, unfortunately, although I still think that's a bit extreme.
Annabel, what does the Reserve Bank take into consideration when deciding on whether to keep the interest rate on hold or increase incrementally?
Yes, so I think, one of the key points I take into consideration is, of course, what inflation is doing, but more importantly, what inflation is expected to do, and having a look at inflation in the future. And that's really the key point. It's not about what inflation is today, or in fact what it was last month, but it is actually about what inflation is likely to be in 18 to 24 months' time. 12 to 18 months' time is really the sweet spot where the Reserve Bank feels it can influence inflation as much as it can, maybe even 6 or 24 months. And, they are aiming to keep inflation around 4.5%. They've managed to do so over the past few years. But obviously, we are facing upwards price pressures now. And that, of course, is the higher oil prices and amongst other factors such as rand weakness. And of course, if the Reserve Bank is not seen to hike interest rates by 25 basis points today, we might see the rand move to 16 rand to the dollar or worse. And of course, again, as I said, that'll put upwards pressure on inflation, both now and in the future. And that is what the Reserve Bank is primarily looking at.
Explain that to me. Why would that push up the rand-dollar rate?
So globally, we're seeing emerging market economies hiking interest rates, or certainly beginning to hike interest rates. And of course, we're an emerging market economy. And investors globally will look at emerging markets and they'll choose to put their money where they get the best return. And if our interest rates are low, if we have a poor carry trade, then of course we'll lose out and the rand will weaken. Investors will withdraw money from South Africa, from their South African assets and investments, and invest it elsewhere in the world. Recall earlier this month we saw the Federal Reserve Bank, the United States NPC Committee, if you will, the FOMC, moving into a tapering of its quantitative easing. And that really means purchasing less assets each month. That's a precursor to eventually hiking their interest rates. And of course, advanced economies have lower interest rates than emerging market economies. But of course, at some point, they are going to start hiking. And emerging market economies are already hiking their rates. So basically, it's just, foreigners having a look and seeing where in the world they get the best return. And of course, if South Africa is not moving on its interest rates, we could be left behind. And of course, see money withdrawn.
Thank you so much there for your analysis. That was Annabel Bishop, the chief economist at Investec, and we'll keep our ears and eyes open for that announcement by the Reserve Bank a little later on today.